Welcome to another video. This is Callum Thomas from Top Down Charts, and we are looking at the weekly macro themes report here. It's from a couple of weeks ago, and really there's a couple of reasons for this. The first of all is just to let you see what the report looks like. Second of all is to take you through one of the themes, just to give you a bit of insight and give you a bit of value. So what the topics were in this one was the US dollar index, emerging market equities outlook, Indian equities, US REITs, and Korean geopolitical risks. So it's kind of a good idea of what kind of topics we'd like to cover. Now, the one that we're going to be talking about today is the US dollar index, and it's at number one in this report. So as always, starting from the bottom line, the setup in DXY, or the US dollar index, is superb. It looks like a bull market correction, but if not, there's a clear line in the sand, which is helpful from a risk management perspective. So let's take that statement apart chart by chart. And there's three sets of charts that we're going to be looking at today. First set is these two. And really what this is a technical and sentiment display here. First of all, we've got on the left side speculative futures positioning. This is in the blue line, it's aggregated across all currencies. The red line is the US dollar index futures itself. And you can see there that, having been quite a crowded net long trade, it's now moved over to the short side. So big washout of positioning there. It's always harder for the market to go up when positioning is stretched to the long side. So when you do see a washout like that, it tends to at least lower a barrier. And on the technical side of things, this is a breadth index, so very much like the breadth index that you see in the stock market, and that's been washed out all the way down to zero. Now you do see that when you see a trend change, so that is the cautionary tale there. But you also see it when there's just a bull market correction, for example, as we saw there. And it is really what the thesis is for this, is that it is a bull market correction. And you can see there on this chart here, the US dollar index is really sitting at quite a critical level there from a technical standpoint. It's support level. So that's why I said at the start, here's our working theory, and I'll get into the rest of it in a second. But from a risk management standpoint, the moment it breaks through support there, then you tend to think that that's no longer a bull market correction, that's a trend change. And that's the thing about markets economics. You have to be open-minded and willing to accept the cold hard truth of reality. If the market's saying that your theory is wrong, you have to listen. So the second set of charts, we're showing again speculative futures positioning alongside the valuation indicator there. So it had gone into overvalued territory, now it's into slightly undervalued. And over onto the other one, this is probably one of the more compelling sides of it, is that the yield support indicator is pointing to still substantial support for the US dollar index, or the US dollar more broadly. And this yield support indicator is comprised of a number of interest rate differentials, the shadow cash rates, real cash rates, nominal cash rates, and 10-year bond differentials. And the reason why that would set the direction for the currencies is a couple of reasons. First of all, it gives a gauge to the predominant economic monetary trends in the economies, and on a relative basis, but also just due to plain old yield demand. Because the higher the yield or the interest rate in one currency versus another currency, the more of an incentive there is to put your money into that one with the higher yield. And by the same token, the more of a cost there is if you wanted to short it, or the more of the opportunity cost if you went elsewhere. So this is like these sort of four sets here of charts. So the technical and sentiments indicators showing a big washout, arguably oversold conditions, in the context of slight undervaluation and fundamental support. Now, the final set of charts really is kind of like the wild card. And what we've got here is two charts that are simply showing really tightness of capacity in the US labour market or full employment. And it's from a number of angles. So, the problem is if you just showed unemployment rate, people would say, oh, there's all sorts of data issues with that, and, it's not telling you the full story. But then you look at this one to the left, and it's looking at the consumer confidence sub-index, jobs easy to get, and the small business confidence index, which is saying firms are finding jobs hard to fill. And really what that is saying, it's, the small business, the headline there, small businesses are saying it's hard to find workers, consumers are saying it's easy to find jobs. And they're saying that to the extent that, the likes that we saw at the peak of the business cycle in the previous two rounds. So, taken together, that's a picture of full employment, and what that means is that, first of all, that ticks one of the boxes for the Fed's targets. The Fed has got a dual mandate. It's supposed to generate inflation around target, and it's supposed to have full employment. So it's got full employment now. Inflation has been wobbling around. I think it's overshot to the downside, and I think, the Fed's going to look through that weakness, that temporary weakness. And, a number of forces point to higher inflation, and certainly these charts point to higher wage inflation. Now, the so what of all that means that the Fed, these two charts here is probably the biggest justification that the Fed could point to if it was going to go faster and more aggressive than expected, and that could be on either interest rates or quantitative tightening. And if it does that, then that's the kind of thing that will tend to put upward pressure on the US dollar. If you think about quantitative easing tending to be a monetary supply expander, quantitative tightening does the opposite and should have a strengthening impact on the currency. So that's pretty much it in a nutshell, really. Like, there's been looking at the sentiment technicals, big wash out there in the context of still fundamental support and potential upside in the form of, the scope for the Fed to go faster than expected. And, if all else fails, you just keep watching the price, and, sometimes, you can look at all the fundamental charts, look at all, the Fed arguments in the world, but, you have to watch price and listen to what price is telling you at the end of the day. And that's why I always say, you should be looking at a multi-factor approach, and that's what we do, sentiment, technicals, fundamentals, valuation, economics, and that's pretty much a good example of the kind of work that we're doing here, and hope you enjoyed this. If you have any comments or questions, do go ahead and put them into the comments box below, and be sure to subscribe to the channel because we'll be putting out more of these updates in the weeks and months ahead.